Thank you for joining us today. In today's webinar, we'll be diving into taxes and retirement. Before we get started, I'd like to introduce our speakers for today. Sean Clark and Chris Maxey are investment advisors with Brookstone Financial. Brookstone advisors have been featured in USA Today and the Wall Street Journal. You can hear Sean and Chris on the radio every Thursday morning at 8 a.m. on Money Talk 1010 a.m. and 92.1 FM. Let's go ahead and get into it. Your speaker today is Mr. Sean Clark.
Hey everybody, thanks for joining us today, and we really appreciate you being here. And what a crazy time it is, right in the middle of a pandemic, and also the stock market has been extremely volatile. And I'm sure that you're here to hopefully hear about taxes, but we're going to talk a little bit about that stuff as well. As I'm sure the more information, the better. As we feel as the more information you get, the more you can make an informed decision on what's going to be best with your retirement funds. So before we get started, I just want to ask, has anyone ever done a jigsaw puzzle, one similar to this, either a 500 or 1,000 piece puzzle? I want to start with this question. What do you think is the most important piece of a puzzle? What do you think is the most important? Well, I've heard the corner piece, that's usually where you start, or the side piece. One really creative answer is the last piece. All the pieces have a really important part of the puzzle to create the entire picture. But what I would say is the most important is actually the picture on the box. The picture on the box. Can you imagine doing this 1,000-piece puzzle without that picture guiding you on what to do? And so when oftentimes people come into our office, we'll ask them, hey, tell us about your retirement plan. What they'll start off by telling us is, well, I have a 401k, or I have an IRA, or I'm going to take Social Security at 65, or, well, those were all pieces of your retirement puzzle. But what I'm asking for is, tell me about your plan, your picture on the box. And what we end up finding is that a lot of people have pieces of the puzzle, of their retirement puzzle, but they don't have that picture on the box, if you will, that picture on the box. So that's what we try to help people with, is taking all the pieces of their retirement puzzle, from their pensions or their Social Security, IRAs, 401ks, 403bs. We put those all together to show them the picture on the box. And I know you're here to hear about taxes, but it's impossible to talk about taxes without talking about a financial plan. I mean, if you don't have a plan, we don't know how much you're going to be able to make in retirement, and we won't know how much you're going to be able to be taxed in retirement. So you're going to hear me say the word financial plan probably at least 50 times today, because we feel like it is so important, especially when talking about taxes. And typically the first step in building a plan is choosing an investment advisor to help guide you through that process. I'm going to tell you a story about a real guy, true story. These are not his actual pictures, but this is a story about a guy by the name of Bill Metzger. Bill retired at age 46 years old with $2 million. Not too bad for a 46-year-old. Anybody want to take a guess on how he did it? Well, he built and sold a software company out of Kansas, of all places. You would think that'd be a hotbed for software, but that's what he did. But Bill didn't know money, so he decided to choose an investment advisory firm to help guide him through that process of retirement. And Bill interviewed Wall Street firm after Wall Street firm, but he finally decided to go with the one that said that they were going to give him direct access to the best advisors and the best analysts they had on their team. He was going to get direct access to their A team, they called it. Well, this was 2006. 2006 was a pretty good market year. Anything wrong with 2006? 2008. Yeah, 2008 is right around the corner. So what do you think happened to Bill's accounts in 2008? Yeah, they began to fall. And again, Bill didn't know money. He was told, let's make your investments grow. Let's create income. But as Bill's investments started to fall, he noticed that he was obviously upset. This is not how this is supposed to work. And so he called his advisor. What do you think his advisor told him?
Just wait.
Just hang in there. That's just paper loss. It'll come back. Well, by the end of 2008, Bill had lost $900,000, nearly half of his retirement savings, which is a huge amount. And what was worse, when he called the firm, what he learned that his advisor had left the firm months ago. So now Bill is out half of his retirement savings, and the A team that he was promised has now vanished. Bill's furious. He's beyond mad. So not only does he sue the brokerage company, or not does he fire the brokerage company, he decides to sue them. Have you ever heard of anybody suing Wall Street and winning? It doesn't happen often, but Bill won. So how much did he lose? $900,000. So how much should he have received in the lawsuit? You think about 900 at least. Well, the judge ruled and Bill was awarded $10,000. But the reason I tell you the story is the judge looked at Bill and the judge said, Bill, not one member of your A team had a legal responsibility to put your best interest first. Not one member had a legal responsibility. In our industry, we call that a fiduciary. Chris and I both hold our Series 66 license. That makes us a fiduciary. You've probably never heard of that license. You have no reason to have heard of that license. But what's interesting is that less than 8% of people in our industry, financial services, hold that license. And what that does is it legally requires us to act in the best interest of our clients. So whoever you choose to guide you through that process of retirement, I just think it's so important that you work with somebody who is a fiduciary, someone who has not only says they have your best interest at heart, but someone who has a legal responsibility to have your best interest at heart. So Chris and I are investment advisors at Brookstone Financial. What makes us different? Well, we primarily focus on planning. We primarily focus on the retirement plan, not product sales. We're not trying to get our clients the biggest and best return. Our focus is creating a plan, and the plan dictates what investments go inside of that plan. So we're getting ready to jump into the tax portion, but before we do, I want to remind you that because we can't take questions in this webinar setting, it's really difficult for us to take questions. What we've done kind of out of necessity is made this kind of a two-part. So today's kind of the lecture portion. Chris and I are going to give you as much information as we possibly can in an hour. And then we're going to talk a lot about tax strategies and different things you could do. But we don't know that that's going to be the right thing for you specifically because we don't know your specific financial situation. So we found that a lot of people were leaving with more questions than answers. So what we did was we created what we call a lab session. So throughout the presentation, you'll see this offer come across your screen. I'll go ahead and send it now. And what this will allow you to do, if you click that schedule now, that will allow you to put some time on Chris and I's calendar to answer any questions that you had throughout this webinar. We certainly don't want this webinar to leave you with more questions than answers. So we'll schedule it. Typically take, we schedule out an hour so we can answer all your questions. It may not take that long. But we just want to make sure we're answering those questions because that's the last thing we want to do is leave you with more questions than answers. So if you don't want to see that, just X that out and we'll continue on with the presentation. But I want Chris to share just a few of the new tax laws that I think could impact you this year.
Yeah, that's definitely the case. And one thing that is a big difference is your retirement is going to look considerably different than your parents' and your grandparents' retirement. So with these three new tax laws, these are must things that you definitely need to understand as the world continues to move and progress. I think this is going to be really important for you. The first thing I want to talk about is the Jobs Act of 2017. That was actually put in place in 2018. So for 2018 and for 2019, you've seen the changes on your taxes. So the big question that we get a lot is this going to go in perpetuity or is this set to expire? Well, this is actually set to expire in 2025. So it's from now until 2025. At that point, it's going to revert back to what it previously was. A lot of experts are analyzing this and they're expecting this to cost the government some money. And it's a pretty big number. I'm going to say it's a little bit more than $1 million, a little bit more than $1 billion. They're saying that it's projected to cost the U.S. government $1.5 trillion. It's a lot. That's definitely a lot. But what does that actually mean for you, for me, for us as citizens? Let's dive into that and let's take a look here. So if you look on your left side of the screen, everybody's familiar with the 10, the 15, the 25, the 28, and so forth tax brackets. Well, that was prior to the Jobs Act of 2017. If you did your taxes in 2018 and 2019, you'll see that the new tax brackets are now 10%, 12%, 22, 24, 32, and so forth. So if you were previously in the 15% tax bracket, now you're in the 12%. If you're in the 25, now you're in the 22. If you're in the 28, now you're in the 24. So what we're seeing is that's where a majority of Americans are at, between that 12 and 24% tax bracket. So for a majority of Americans, taxes are actually on sale for their income tax between 3 and 4%. So that's a pretty cool thing. That's pretty exciting that you're getting a tax break. Taxes are on sale between 3 and 4% for a majority of Americans. If you look back at the 25% tax bracket, you'll see that that's actually capped at $156,000. Well, let's go over to the other side of the screen and look at your 22%. That's actually been expanded to $165,000. So more Americans will fall in the 22% tax bracket. And then if you look at the 28% tax bracket, that was previously at $237,000 at the cap. Well, now that's expanded to $315,000. So again, we're just seeing more and more Americans fall into this 12, 22, and 24% tax bracket. So most Americans will see a 3 to 4% reduction in their taxes this year until 2025. And then after 2025, well, it's going to jump back up to what it previously was, and potentially even more. So who knows what's going on with the standard deduction? Is it going up? Is it going down? Did it stay the same? It's actually gone up. It's actually gone up pretty significantly. So for individuals, it previously was $6,300. For married couples filing jointly, it was about $12,700. Well, what we're seeing with this new Jobs Act is that for individuals, it's actually almost doubled to $12,000, and for married couples filing jointly, it's almost doubled to $24,000. So, but what also has happened is the personal exemption has gone away. That's kind of been gobbled up by the standard deduction here. So that's gone. Everything falls into the standard deduction. So what does this actually mean for us as individuals? What does this mean for you in your everyday life? Well, I mean, who in here has done their itemized deductions year over year? Yeah, I definitely have, and it's not the most fun thing to do. So what we're seeing is that a lot of individuals don't deduct over $12,000, and a lot of married couples filing jointly don't deduct over $24,000. So it simply might not make sense anymore to do an itemized deduction. So we might be saving you some time because you're not going to be deducting more than what the standard deduction is here. The second thing is, if you're giving to charity simply for tax purposes, well, that might not make sense anymore. And I'm not saying that because don't give to places that you appreciate and want to expand on. My wife and I, we know about this rule, but we continue to give to the charities and the services that we appreciate and are bettering our community. But what I'm saying is, if you're doing it simply for a tax break, well, it just might not make sense to give $24,000 to get down to a lower tax bracket. So if it's simply for tax purposes, I would look other directions here. So the third thing is the Secure Act. And a lot of people don't know about the Secure Act, or they don't know everything about it. Well, these are some of the biggest principles that we're seeing. This was actually put in place on December 20th of 2019. It just kind of slid in there, right? We had Christmas going on. We had a lot of political stuff going on. We just fell into the pandemic. So there's a lot of things going on, and a lot of people don't know about it. So the first thing I want to talk about are RMDs. That stands for required minimum distributions. Those impact your 401ks, your 403bs, your IRAs, anything that's considered tax deferred. It previously was at 70.5. You are actually, the government requires you to take money out of that, and they determine it. Usually it's at like 3.5% to 4%, and each year it increases gradually over your lifetime. But all that to say, it's previously was 70.5. Now it's actually been expanded to 72. We see this actually as a really positive thing. This is going to give you more opportunity to draw from these funds and to figure out a plan before it used to be 70 and a half, now it's 72. So we see this as a really good opportunity. The next thing is you can now contribute to your IRAs past 70 and a half. Previously, it was at 70 and a half, you had to discontinue giving to that, but now you can continue to move forward. We see this as it's okay, but like I said before, taxes are on sale right now. So we see as an opportunity that we'll talk about later, but just to continue to put money in your tax deferred investments could cause you a lot of trouble down the road when we know that taxes are going back up. The last thing I want to talk about is your inherited IRAs. This is something that we see as the biggest change that we've seen in a decade of retirement planning. This is a massive thing. And if you don't know about this, this is something to put a star by it, put an X, circle it. This is huge. So right now, or so previously, if you had a 401k, an IRA, a 403b, any of these tax deferred vehicles, and let's say you pass away and maybe you're married and your spouse passes away and these assets go to your kids. Well, usually what happens is you pass away in your 80s or 90s and your kids are in their 50s or 60s, their highest income earning years, and you pass these assets to them and they get to take out RMDs every year until they pass away. But it's there, they have the plan to do it. Well, now what we're seeing with this new change is as soon as you pass away and pass those assets to your kids, they have 10 years to take all this money out. Used to be their whole lifetime. Now it's 10 years in their highest income earning years. So this is a potentially huge change that we're seeing where, that's 10% a year. And most people save most of their money in their 401ks or IRAs. So they're going to have to take out 10% a year of those funds and be taxed on that every year. And let's say they're not planners. Let's say that they don't do anything with it. And then it just grows and grows and grows. And then at the end of that 10 years, they take it out. Boy, they're going to get absolutely hammered. That's money that you work for. That's money that is your money that is now going to be taxed significantly heavier simply because you didn't have a plan with those funds. So this is the kind of thing that we talk about and we think is incredibly important for you to, determine and make a strategy behind, because we see this, they just made the rule change right now. So we need to figure out how we can impact this and make the best moves possible with this. So if you're concerned with these, just like I said, make a star, make a check mark, write it down if you have a pen and paper with you, but we'd be happy to talk with you about this further.
We're going to jump into Social Security, and Chris and I love the topic of Social Security, but what we find is that people oftentimes, Social Security is one of the largest financial decisions that many Americans will make in their lifetime. And, and what we find is that oftentimes they spend more time planning their summer vacation than they do figuring out when they will elect when to take their Social Security. And so, our opinion is probably worth 30-minute conversation to make sure you're getting the most out of what you've paid into your entire life. So I want to look at just a couple questions. What is the earliest you can take Social Security? Many of you may know that it says age 62. But what is your full retirement age? And we do this in our live events.
Yeah.
Oftentimes people are like 66, 67, and you may both be right. It's a trick question because your full retirement age is based on your date of birth. So people born between 1943 and 1954 have a full retirement age of 66. However, between 1954 and 1960, there is a sliding scale where they add 2 months for every year after. So if you're born in 1955, your full retirement age will be 66 and 2 months, and so on, all the way up until 1960. If you're born after 1960, your full retirement age will be 67. Anybody want to take a guess on what mine will be?
67.
67 as of right now.
That's right.
But we'll see if that changes. So 67. But let's just get a brief, before we jump into how Social Security is taxed, I want to show you just how it works, just so we are all on the same page. So you can see that, yes, you can take it at 62, but are there any catches, any penalties? Yeah, you're going to take a 25% penalty on what you would make if you wait till your full retirement age. So really important that you will be getting less than what you could have gotten if you wait. So if you wait, you get more each year. 80% at 63, and this is for someone whose full retirement age is 66. This is just an example. But they're going to get 100% of what's called their PIA. That's their primary insurance amount. If you get a Social Security statement up in the top right-hand corner, you'll see that number, and that's how much you receive at your full retirement age. That's your PIA. So can you delay it after your full retirement age?
Oh,
sure. Yeah. What happens if you delay it?
rolls up.
Yeah, you get more. So, and actually an 8% simple interest roll up. Yeah, so 8%. So, if your full retirement age is 66, if you wait till 70 to take your Social Security, you actually get 132% of your primary insurance amount. It's pretty crazy. And so when electing Social Security, it's not just, well, I'm going to retire, I should just take it now. Well, that's one consideration, but we've also got to take into consideration longevity. Do you have longevity in your family? Mm-hmm. And Social Security, it's all about coordinating it with your other assets. So right now, if you go to the bank and put in your money in a CD, you're going to get what? Maybe 1%, maybe 2%. Yeah. Interest rates are really low right now. Well, what sounds better, 2% at the bank or 8% guaranteed by your federal government?
Yeah.
And that's a nice bump. So that's the things we take into consideration when we look at Social Security. Maybe we take a little bit out of that bank account for year one, so we can delay the Social Security and get even more.
Right.
And so we factor this in with your other assets and build that holistic plan to make sure you're getting the most out of Social Security. So now let's jump into how it's taxed. And I promise you that they have made this the most complicated calculation that they could have. And we have these nice little guides. I'll hold it up here. This is the 2020 Taxes in Retirement guide, and it gives some nice breakdown of all the different taxation. And we'd be glad to email this to you. Just shoot us an email. Our information will be on here after the webinar, and you can certainly send us an email and request one of these. We'd be glad to send this out to you. But what this says is that if you're married and filing jointly, and you make more than $24,800, your Social Security will be taxed. Or excuse me, I'm sorry. If you make more than $32,000, your Social Security will be taxed. If you make more than $44,000, your Social Security will be taxed. 85% of your Social Security will be taxed. So yes, you pay tax on it when in your working years, and yes, many people will pay tax on it when it comes out. But I want to show you, those numbers seem really low, but that's based on provisional income. Provisional income is really kind of confusing. It's based on your what's called your modified adjusted gross income plus half of your Social Security, and that equals your provisional income.
Confusing.
It's so confusing. Let me give you just an example. So let's say that your modified adjusted gross income was $20,000, and you made $20,000 Social Security, and you're married filing jointly. What would be your provisional income? Well, it's $30,000 because it's half of your Social Security. So 20 plus 10 equals 30. Now, let's say you're clipping right along, and that's under the $32,000, so you're not paying any tax on your Social Security. Right. Everything's going really well. But you get to age 72. Chris mentioned this earlier. What happens that's really important at age 72?
RMDs.
You have to take that required minimum distribution out of your IRA or your 401k. Well, let's say you had a $5,000 RMD. Now your modified, your gross income is $25,000. You're still getting 20 in Social Security. Now your provisional income is $35,000. Well, that jumps you over the threshold, and now half of your Social Security is taxed. The 12% tax bracket. That's an extra $1,200 in tax. That's significant. And if you could avoid that, it'd be worth looking at some strategies to maybe potentially do that. What if you saved a lot? I mean, what if you had a significant amount in 401k or IRA, like many of the clients we see do? What if you had a $15,000 RMD, which is not uncommon? We see this all the time. Now your gross income is 35 plus your 20 in Social Security. That bumps you up to 45,000 in provisional income. that puts you to 85% of your Social Security is being taxed. That's an additional $2,040 in tax just on your Social Security.
Yeah.
I mean, it is, and that's what we look at. And there's no way to find this out without putting together that holistic plan to cast out what does your RMD look like when you get to 72, and how will that affect the taxation of your Social Security. So look, I want to show you one more thing on Social Security. It's the earnings test. If you take Social Security early, if you take Social Security before full retirement age, so let's say your full retirement age is 66, if you take it at 62, the government won't allow you to make more than $18,240. If you do, for every $2 over that, you earn an earned income. That's earned income, not money you take out of pension or 401k or anything like that, but earned income, working. For every $2 over, you lose $1 of your Social Security.
Yeah.
So we had somebody come in the other day and they said, hey, I applied for Social Security like 3 months ago, but I haven't received a check. Well, I said, Mr. Klein, are you still working? He said, well, yeah. I'm like, well, you make too much money. You're not going to receive any checks.
Yeah.
So if that's happened to you, there are some strategies to be able to get out of that, but make sure that you schedule one of these appointments and we can talk through that. But listen, if you don't have a Social Security strategy, if you've never put that together, coordinate it with your other assets and talk to a professional, I mean, it's definitely the worst. It's definitely worth a 30-minute conversation to make sure you're getting the most out of what you got. So I'm going to pop this little calendar invite out. Feel free to go ahead and schedule a time on our calendars right now so that we can talk further about that. We've been getting a lot of questions about capital gains. Now, capital gains haven't changed with the Jobs Act of 2017. They're still 0, 15, or 20%, depending on which tax bracket you fall in. However, there was some new opportunities introduced in the Jobs Act that could help you. So I want to point out a few of those. Now, does anybody own any real estate? Now, not necessarily your personal real estate, but outside of that, rental homes, commercial buildings, anything like that. You've probably heard of a 1031 exchange. This is where you sell one property, defer the taxes into the next property when you buy the next property. And there's a lot of rules. You got to use a qualified intermediary. The money can't ever touch your hands. But what it allows you to do is defer those gains into the new property.
Yeah.
When a lot of people get to retirement, you know this, Chris, they want to get out of the passive. They want to get out of the active real estate. They're tired of the tenants and the trash and the turnover.
Yeah.
And they want to get into passive real estate investing. Well, when it's suitable, we actually have options of passive real estate options where they can sell their real estate, defer the capital gains into a real estate like investment. And then it becomes passive. We call it mailbox money.
Right.
And the beauty of this tax strategy is we call it swap till you drop. You keep 1031 exchanging up until the point until you pass those assets to the next generation. Well, at that point, the value of the property at that time is the value of the property when it goes to your kids. So you can completely eliminate those capital gains taxes.
Yeah, this is a really powerful strategy if you do have, if you do have real estate and if you're wanting to get out of it. This is something to definitely consider.
Yeah, so if that's you, again, you can set up a time to talk to us and put some time on our calendar. We can talk more about that.
Yeah, so we said it before, right? RMDs. We talked about PIA, FRA, but we also talked about RMDs before, and that stands for Required Minimum Distribution. And the big change that we've seen on this with the new Secure Act is that it went from 70.5 to where it's now 72 years old. So that's where if you have money in your 401k, your IRA, your 403b, these tax deferred vehicles is basically, basically when you have money in that, you've partnered with the IRS. Let that sink in for a second, right? That kind of sends a shiver down my spines, right? So you've partnered with the IRS. And when they say jump, you say how high. If they say pay your taxes, you say how much. If they raise your taxes and they say pay it, you have to do it, right? Or you get a big fine or you go to jail.
Yeah.
So think about your net worth. I mean, just think about it for a second. Have you saved most of your money in your 401k or your IRA or your 403b? For most people, the answer is yes. Most of their money are in these tax deferred investments. And this is what's impacted by these RMDs. So this is something, so take note of this. This is really important to think about. So your RMDs are now 72 years old. They affect your 401k, 403b, IRAs. What type of accounts do they not impact?
That's your Roth money.
Yeah, that's right. Your Roth IRA money. That's money that you pay in. You pay the taxes when it goes in, and then it grows tax-free. But let's think about this. What happens if you miss one of these RMDs?
Significant.
You get a penalty,
Yeah.
right? You get a penalty, a pretty sizable one at that. It's actually a 25%, what they call excise tax. So if you miss an RMD, which is something that happens, people, they don't know about this, and all of a sudden they are just taxed to this 25%. This hurts, right?
Mm-hmm.
And this is the worst time that you can get hit with this big tax. So let's take a look at this and just look at this example here. So let's say that you have a $15,000 RMD, and let's say that, oops, you missed. Well, there's a 25% penalty right there. So that's $3,750. That's a pretty big mistake. That's a pretty big oops. That's a pretty big uh-oh. That's money that you stored away. That's money that you put away, that you went without to make sure that you were taken care of in retirement. And then just like that, gone. That's not a fun thing, but okay, Mr. IRS, I made a mistake. That's my mistake. These are your rules. You take your $3,700 and I'll go home. Well, we still need to pay the income tax on that. And if you're in the 30% tax bracket, that's an additional $4,500, leaving you with, out of that $15,000, $6,750.
Less than half.
Less than half, right? And this is something that people often don't think of, right? You're putting money in year over year into your 401k or your IRA, and it's growing and it's doing fine. But all that money's not yours.
Yeah.
Think about it. If this is the first time you're thinking, think about that. All that money is not yours. You still need to pay taxes on that when it comes out. And if you make a mistake, there could be a potential penalty with this 25% excise tax. That hurts, right? That's a pretty significant thing. So I want you to think about this for a second. When is the best time to buy something?
I know, when it's on sale.
When it's on sale, right? So what is that? Black Friday, Black Friday, Cyber Monday, all of these days that have big sales are when we buy things, right? So when something on sale is the best time to purchase something. Well, what I just talked about before, taxes are currently on sale for 3 to 4% for most Americans. So this is the time where we see as an opportunity for you to take full advantage of that. And what I mean by that is I want to talk about, we said it just briefly, Roth IRAs, right? Roth IRAs are, you pay the tax already and then they grow tax-free. So I want to make, there's two different things. There's a Roth contribution and there's a Roth conversion. Now with Roth contributions, there are limitations to that. You can only contribute a certain amount. You have to be working to contribute, and you can only make a certain amount. So there's limitations on Roth contributions, and a lot of people don't do that because they don't know about it or they can't contribute. But every single person on here can do a Roth conversion. Everyone on this webinar can do a Roth conversion no matter what. So what does that exactly look like? So basically, let's say you have money in your 401k or your IRA, your tax deferred dollars. What we would simply do is we would pay the tax now, convert that to a Roth IRA, and then that Roth IRA grows tax-free. So then at 72, guess what? We don't have these required minimum distributions. We don't have to take money out. We can do what we want with those funds. So again, we have a 401k or an IRA. We take the tax now because it's on sale. We convert it to a Roth IRA, and then that grows tax-free. And we don't have to worry about these RMDs. It's a pretty powerful thing. And I'm not saying it's for everybody, but everybody should consider it. It's something that can be a big impact on your retirement. And it really breaks the chains with the partnership of the IRS, right? It gives you more control of your funds, and it differentiates your tax statuses for your money. So let's look at this example. Let's say that you're a married couple filing jointly. Let's say you make $60,250 a year. That would put you in the 12% tax bracket. Well, the top of the 12% tax bracket is $80,250. And so with Roth conversions, we don't want to convert all of your 401k money all at once, because that would jet you up into the top, potentially the top tax bracket. That's a problem. If you're in the 12% tax bracket and we put you into the 37% tax bracket, that's a big problem, and you should not be doing that. So year over year, we want to systematically try do the Roth conversions. So what we'd simply do here is the top of the tax bracket is 80,000. Well, let's do a $20,000 Roth conversion. And we can do that year over year to make sure that we are converting some of those funds to Roth IRAs, therefore giving us more options and more opportunities. If this is the first time you're hearing about Roth conversions, if you're not sure about how RMDs are going to work or how they're going to impact you, I'm going to slide this. I'm going to slide our banner out here, and feel free to click on this. Feel free to take a look at our schedule, and feel free to find some time that would work in your schedule so that we can talk about this further to see if Roth conversions are the best thing for you. It's definitely something to look at in your retirement, as taxes are currently on sale, and we know that they're going back up in 2025. So we talked about the previous tax law. We talked about the current taxes. We're going to talk about what a lot of experts are saying about the potential future of U.S. taxes. So who knows what the current U.S. national debt is?
It's a lot.
It's a lot. It's pretty hefty, right? Wow, look at that. That's 23,329,287,910. And to be honest with you guys, these numbers are old.
Yeah.
So it's gone up since then, and we just tacked on another $2 trillion for the stimulus package. Is this a concern?
I think it should be.
Yeah, I think so. I'm definitely concerned. I'm definitely concerned by this. And just look how this number has just gone up. It has just catapulted in recent years. And folks, this is not a political statement. This is not a political conversation. This is a mathematical conversation for us, right? This is something where, think of your own personal finances. Just think about yourself right now. If you're in debt, how do you get out of it? There's two ways, right? You can make more money, and you can spend less. Make more and spend less. Well, who thinks the government's going to spend less?
Probably not going to happen.
I'd like to see it, but I don't think that's going to happen, right? Medicare's not going anywhere, nor should it. The military's not going anywhere, nor should it. Education's not going anywhere, nor should it. So what happens? Well, the government can make more. How do they make more? Well, they turn the printing press on, right? They turn the printing press on, or they tax us. They tax the citizens of the United States. So that's something where we definitely need to consider that, and something that we need to think of in the future. So I want to talk about this. So I told you how taxes are on sale, right? But who kind of still thinks that they're paying a little bit too much in taxes, right? I want to pay my fair share. I love this country. I love being part of it. I love the opportunities that it gives us. But yeah, I don't want to pay an arm and a leg. But who knows what the top marginal tax bracket was in 1948? I'll let you think about that for a second. So the top marginal tax bracket now is 37%. Well, let's take a look at this chart. The top marginal tax bracket in 1948 was 96%. Let that sink in. 96%, right? It's 37% right now. This chart is the top marginal tax bracket for the last century. And look at it. It's up and down. It's volatile. It looks more like the stock market than it does taxes. I mean, look at that. That's a wild thing to see right there. It's up, it's down. But the one thing to take away is that we've been told our entire lives to put money in your 401k, put money in your IRA. Your CPA said to just kick that tax can down the road. Well, if you look at our current trend, taxes are at historic lows right now. And we know in 2025, they're jumping back up. And we think with the $23 trillion of national debt, the potential for the tax to go up even more is pretty high. we don't have to convince a lot of people that taxes will probably go up in the future. So this is something that we definitely want to take a look at. We definitely want to understand, and we definitely want to make plans to make sure that you're taking care of your money as efficiently as possible. So I want to tell you a story here. Ronald Reagan, he's one of our presidents, right? What did he do before he was a president? Well, he was the governor of California, but before that, he was a movie star, right? He was a movie star, and he had a rule in place where he would make 2 movies a year. You want to know why? Well, when he made that 3rd movie, it jumped him up into that top marginal tax bracket, and he was paying 96%. So you're basically volunteering at that point. So he made 2 movies a year and was done because he did not want to jump up into that top marginal tax bracket. So take a look at this chart here. This is what Americans have put in their 401ks over since 1980. Boy, look at 2008 right there. That was a big hit. But we continue to climb out of that. So this is something that, again, we don't have to convince a lot of people that taxes will probably be going up. And with the new Secure Act, guess what? We know where the government's going to get their tax dollars. Yeah. Right? And it's a very easy place. Like I said, they're going to tax inherited IRAs, which is a big, big, big thing that if you have a lot of money saved in your 401k or IRAs, guess what? They're going to tax that if you're passing that to the next generation. And most people say, oh, or a lot of people say, I'm going to spend all that. I'm not giving any of it to my kids. Well, that's okay. But oftentimes it does go. You don't spend all of it, and it does go to your kids. And guess what? It's going to be taxed pretty heavily. And we think this is another place where the government will go, the IRS will go to make sure that they're taking care of that $23 trillion national debt. And I want to have Sean come in here and let's look at some examples of that.
Yeah, I just think that these 401k assets look like they're just grown and grown and grown. I think this is an easy target. And the government with that Secure Act made it pretty clear what their intentions are.
Shot across the bow.
Yeah,
exactly.
They're going after those assets and trying to get those tax dollars in a way that most people was kind of flying under the radar, which is typical of politicians. So let's look at what it would look like to actually convert IRA money to Roth money. And the reason I want to show you this is the biggest reason we hear of why people don't want to do this is, well, I don't have to pay the tax now, so I'd rather wait.
Yeah,
I'd rather wait. And listen, the biggest reason people have their largest majority of their taxes or their money in tax deferred vehicles like 401k and IRA is largely not their fault. It's what their financial advisor or CPA has been telling them to do it for years. Hey, but their CPA, think about this. Your CPA is always looking in the rearview mirror. You bring him or her your taxes, and they're looking at your taxes from last year, trying to save you money on last year.
Yeah.
So they're always looking in the rearview mirror. You need somebody looking out the windshield going, well, what's this going to do to me 10, 20, 30 years down the road?
We got a pile of tax deferred dollars. What's going to happen?
Exactly, because that money has to be taxed at some point.
Absolutely.
Well, so here's how it would work. So let's say you've saved your whole life and you've acquired $400,000 in your IRA or 401k or a combination of both. And let's say you're in the 20% tax bracket when it all shakes out. When you take that money out, let's say you paid 20% in taxes, how much do you actually have? Because like Chris mentioned, you don't actually have $400,000. You still have to pay tax on that. So when you take that money out, if you take 80% of 400, what do you actually have? Well, you have 320,000. Mm-hmm. Well, if we converted that to Roth, we couldn't, like Chris said, we can't do it all in 1 year, but if you did it over a series of years, kind of a Roth conversion strategy, and you paid 20% on tax, how much would you have in your Roth?
Saying 320.
320,000.
Yeah. Mm-hmm.
So that argument of like, I don't want to pay the tax, well, you're going to at some point. Our argument is you might as well pay it, at least some of it now, while we know that taxes are on sale, because we don't know what the future of the taxes are going to look like.
Well, we know they're going back up in 2025, but
beyond that, we don't know.
Yes.
So if I told you, hey, could they raise taxes by 5%? I think most of you would say, yeah, that could happen. I mean, they just lowered it by 3 to 4. So sure, they could raise them by 5.
Yeah.
Well, look at this example. If they raised taxes by 5% and this individual had to pay 25% taxes, well, now how much do they have in their IRA? $300. They just lost $20,000.
Like that.
Like that. Yeah, but what if you had converted to Roth before they made that change? How much would you have? You still have 320.
Yeah.
This is why we think this is a very unique opportunity in a time in history where this makes a lot of sense. So, and look at this. This is all we're saying. When you think about your net worth, what we see is that most people have saved in three main buckets: tax deferred, Roth, and taxable. Tax deferred, when we look at, think about your net worth.
Yeah.
I would say that for many of you, the biggest portion of your net worth is in tax deferred, either 401k or IRA. If you have a Roth at all, it's usually much smaller from what we see. And then this taxable money, this is money in the bank or small brokerage account or something like that. This is what the majority of the net worth of people we see in the entering retirement looks like.
And look, it leaves you exposed.
Yeah.
It's leaving you exposed to the whims of what's going on outside of your control.
Exactly. And so all we're saying is, hey, let's diversify these buckets. You've heard diversification. Yeah, you need stocks and bonds, mutual funds. You need to diversify your investments, but nobody's talking diversification via tax status. So look, all we're saying is let's diversify a little bit. Let's move a little bit out of the tax deferred into the Roth, make that a little bigger. And the next year, we do the same thing until when we get to retirement, those are a little more even across the board so that we're entering retirement with a more diversified tax strategy. Now, if you're past retirement, you're already in retirement years, it's not too late. So let's take a look at that and see if we can't get a more diversified tax status where you have even buckets all the way across. So look, if you've never looked at the future of U.S. taxation, if you've never seen that as a concern, we think you should. And I'm going to pop that offer out just to go ahead and schedule some time on our calendar to look and see if Roth conversions actually do make sense for you. All right, how do we do it? Well, I'll give you a clue. It's not on notebook paper. It's not on an Excel sheet. We have some very complicated software where we basically all we do is we enter your assets and then we overlay. What are your goals in retirement? How much do you want to make in retirement? Do you want to go on trips? Do you want to buy that RV and travel the country? We take those goals and we overlay them over your assets, and you'll see that it spits out this probability of success. That's the way we can know how much you can make in retirement. Once we do that, then we can stress test it with Roth conversions. Maybe some of your concerns, like what would happen if the high income earner died early? These sort of things. And that's how we do it. It's nearly impossible to do on an Excel spreadsheet. This takes a very complicated mathematical formula taking into consideration inflation and compound interest and these sort of things, and narrows it down to something that's very easy to understand.
Yeah, and I love the fact that we can stress test it, like you were saying. What happens if the high income earner passes away, or if there's hyperinflation or whatever? If you've never stress tested your plan, boy, this is a powerful tool for you.
Yes, definitely. So look, we talked earlier that, we've given you a lot of information, and you may be thinking, well, should I do this? I don't know. I don't know how it applies to me in my specific situation. Well, I want to talk a little bit about that lab session, that hour that we'll schedule to answer those questions that you may have. And here's why it may be a good reason to get together. If you don't have a retirement plan, we can start to build one in that lab session. So that may be a good opportunity. If you're looking to minimize your taxes or optimize your Social Security with a comprehensive plan, again, this is a great opportunity. Maybe you already have a plan, but you've never stress tested it. You don't know the strength of your current plan. We can do that. Also, if you've ever questioned your plan, or if there's any doubt in your mind that you're going to run out of money in retirement, this is a great opportunity to just get a second opinion. And so I'll end with this. Growing up, I raced dirt bikes and still get to do occasionally. But growing up, it was my life. And as you can imagine, as a dirt bike rider, I was an orthopedic surgeon's best friend. So I got hurt a lot, and I dislocated my shoulder. And after it had dislocated, and I spent 4 trips to the emergency room 4 different times, we decided that it was finally time to get it checked out. So I was living in Indiana at the time, and We went to Indianapolis at some of the best orthopedic surgeons group in the country. They work on the Indianapolis Colts and IndyCar drivers, and just world renowned for their work. And we went to the shoulder specialist in that group, and he said, yes, it's actually kind of a fun surgery. Go in arthroscopically. It'll be a small incision. We go in and it'll fix the problem. And so we do the surgery. It's 6 months of healing and another 3 months of rehab, and they have me good to go. And I'm doing a jumping jack. When I'm doing this jumping jack, my arm falls out again. I mean, it was heartbreaking. So we go back to the doctor, and he says, well, that surgery only has a 50% success rate. Well, that would have been nice to know before I wasted 9 months of my life. So he's like, we'll do a full incision this time. I'll be able to see it a little bit better and fix the issue. So do a full incision. He goes back in, and another 6 months of rehab, another 3 months of therapy, and then after that, I think I'm tossing a wiffle ball underhand this time, and it falls out again. And after 2 failed surgeries, at that point, we decided it was time for a second opinion. So go to another large group of orthopedic surgeons. This orthopedic surgeon does the exact same surgery. Another 6 months of healing and another 3 months of therapy, but I've never had an issue since. And that right there taught me the value of a second opinion. And when people face a large medical decision, oftentimes they understand the value of a second opinion. But what we see oftentimes is that with their finances, people just keep doing the same thing that they've always done. And times are changing, especially when it comes to taxes. And we believe, and I don't have to convince you, that taxes are likely to go up in the future. So if you've been kicking that tax can down the road, trying to save money on last year's taxes by deferring them for later, if taxes go up in the future, that could be a real problem. And that's all we're offering, is let us give us the opportunity to give you a second opinion on what you've got. And we're just here to answer any questions that you might have. So what I'm going to do is I'm going to put that offer out one more time. You can go ahead and schedule that time on our calendar. And we would love to talk to you this week, either via Zoom or in person. And we can do that all virtually if you'd like. So go ahead and schedule that now, and we'll look forward to talking to you this week to answer any questions you might have about taxes in your retirement. Thanks for joining us, and have a great day.